When interest rates go up and there are global supply issues and wars overseas, people assume the entire real estate market gets affected together. That is simply not true. Last week, I was asked this question easily 25 to 50 times. So I'm going to make this video to clarify this once and for all. So if you're concerned about how interest rates going up and overseas issues affects the real estate market, this is the video for you. The real estate market is not one market. There are bands in this market. And for this video, let's say we have the $0 to $1 million band, 1 to 1.4, 1.4 to 2, 2 to 5 mil, 5 mil plus. Let's go through this really quickly, band by band. 0 to 1 million, supply levels don't increase. The increased interest rates don't really affect this market too much. 0.5%, 0.75% is typically manageable, can be a bit of a strain, but manageable. And so people don't need to sell. People in this market are typically in the market for a needs perspective and not an investment perspective, for example. And so supply levels stay restricted. Demand stays high as this borrowing power amount is very common. It's quite manageable to be able to get these amounts of money even with increased interest rates. And this market typically still moves forward and you can still get great value in this market. 1 to 1.4 market, this is where the market starts to stabilize. The increased interest rates do start to have more of a mortgage repayment effect. And so some people will start to have to sell and the demand starts to come down as well as borrowing power gets restricted due to higher interest rates. And so you have an equilibrium occurring. And so this market stays a bit stagnant. 1.4 to 2 million. This market starts to drop, starts to come down a little bit. Supply levels start to increase as these people are affected by the increased interest rates and mortgages become a bit more expensive. People get a bit more squeezed. People probably have an extra property here or there. And so they tend to be able to sell one and still have their principal place of residence. The demand level also comes down. People in this bracket typically were already limited because it's on the higher end. And now with increased rates, borrowing powers become harder and get hit. And so you have less demand, more supply. These prices start to come down. 2 to 5 million, similar to the bracket before, but on a much larger scale. Already much less people have $2 to $5 million to spend. With increased rates, their borrowing powers continue to drop and get dropped heavily. From the supply level, supply starts to come up as well because these people get heavily affected by an increase in interest rate. 5 to 10 mil and 10 mil plus, you have two kinds of camps. You have the people who are highly leveraged, business owners, high net income people, but they are still tied to interest rates. And so these markets get affected from that perspective. But also you then have the other side where people who are the ultra rich who are not affected by interest rates because they're usually cash heavy, but more confidence issues rather than interest rate issues. Markets tend to drop in those areas, in those bands. So overall, market is not one market. The cheaper and lower end of the market typically is actually unaffected and in fact continues to go up in value. And the markets that are on the top end typically are more affected and start to come down.
Quick thing before you go. If you're thinking about investing in property, I've created a free guide called 8 Mistakes First Time Investors Make. Just comment property and I'll send it through.